We're rolling here in just a second. Laura, we still waiting? Oh, there we go. We got Geof. Geof, welcome. Jack here. Jack's coming in.
Yo.
There we go. There he is. All right, let me get my sound here. I'm not hearing too good. Oh, there we go. I know what's going on.
Hey, Jack.
Hey, Geof, how are you?
Good, thank you.
I always get excited when I know you're going to be on because I learn more from you in 15 minutes about commodities than I've learned my whole life.
Amen.
Talk about
Amen.
beef forever.
Same here. All right, guys. Jack, thanks for being here. Geof, welcome. All right, we got everybody. We got a great lineup here. Great set of discussion points, and it is almost, well, it is 10 a.m. So why don't we get started? I think, and so for everybody, I just assume everybody's familiar. I know everybody knows Jack. Geof, just assuming they're everybody's familiar with you. Why don't you just give a quick kind of backdrop, particularly with the experience on the commodity side, since that's what we're going to be focused on with you today.
Well, I've been trading the commodity markets for, I don't know, probably 20 years or so now. Actually, my father loved to trade pork bellies, and that's kind of where I learned. Yeah. And so he said, buy them when they're down at 36 and sell them when they're up at 90. And I was just like, okay, fine. So he was kind of a long-term guy. But from there, I just kind of started dabbling in them and really got to thinking, this is stuff that we use every day. And if I can keep track of this, I can figure out what I'm going to be paying at the grocery store, at the gas pump, or anywhere else. And so I just, instead of just watching them, I started going click, 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 click. And all of a sudden, I just love trading the things. So
yeah, right. It kind of gets you, doesn't it?
It does. It does.
Yeah, awesome. Well, appreciate that. Okay, guys. So the first thing we're going to talk about today, I think, is, last week, the Feds were yammering day after day after day. I think I recorded 6 or 7 Fed speakers from the various heads of the various Federal Reserve banks, every one of them trying to beat down expectations of a soft landing, a pause, or a reversal or pivot or whatever. They wanted the markets to know, but Jack, why don't you? I'd love to get your thoughts on that and what you think that means for markets and everything. What's your opinion?
Thank you for having me on, Don. I think this Fed stuff is very reckless. I think this guy Bullard or Bullocks or Ballard or whatever his name is, he needs to just shut his pie hole. Because the market's going along fine, and then he starts talking about he's all for a 0.5 point hike. You turn around, the market's down 450 points. I mean, that's just recklessness. These guys, if they're going to tell their opinion, they should meet, get their little Fed meeting going, and then you tell each other. But, to be talking like that outside of school, so to speak, that's, and you don't even know who these little chumps are. This Fed president from, where is he from? Columbus, Ohio?
Bullard's St. Louis, I believe. But anyway, yeah.
I think it's dangerous and reckless. And if they want to hike them, hike them. It doesn't matter to me. I'm still going to make money. I don't care what they do with interest rates. But just keep your mouth shut and do your job. Is what I would like to see them do with it. I've never seen these guys talking so much. It's like they think they're celebrities now. It's sickening and reckless and dangerous.
Well, so that's definitely a change, over the last 20 years, in the 90s during Greenspan, right? When Greenspan took over in 87 and that whole time, he actually valued surprising the markets, right? So at that time, it was mostly shocks to rate cuts. Well, I'll take it. They wanted to systemically move inflation lower, which is what they did during the 90s, and so they come out with really surprised them on the FOMC meeting with an aggressive rate hike, and then the market reacted, and that's how they did their work. And then Greenspan came up with this kind of forward guidance, or not Greenspan, but Bernanke, the next Fed, came up with forward guidance, right? And so they're trying to talk through the mess. And so what they're really doing is, they're trying to have the market do the work so they don't have to hike rates as much. That's exactly what they're trying to do, right? They don't have the guts to raise the rates because they know the long-term effect, the impact that's going to have over the next 2 years. So they would much rather the markets kind of do the work for them. But, you know, that's a sloppy way to go about it, especially it's very mixed signals when we meet week to next, right?
I think they should just raise them if they're going to raise them and stop spooking people and that crazy, because here's the best part of the whole thing. Like when we had that zero interest rate environment, the Fed was helpless to do anything, right? He couldn't cut rates anymore. But if you get these rates up, even over 5.5%, whatever, that's going to give him a lot of room to start cutting them again. And that's going to be the next bull spark is when,
Could be.
so get them up high as you want to get them. That just gives you more room to cut them later. So, you know, raise them. I could care less. It hasn't bothered my trading one bit, you know.
Yeah, they're afraid of the ramifications of that. But no, I hear you. I hear you. Jeff, what do you think? What's your take?
Well, I'll go back to your Greenspan idiot guy. I mean, you talk about a fool. I mean, if you go back to 9/11, let's just look at that one alone. They shut the markets down for a week. And instead of letting the market open back up on that next Tuesday and trade for an hour and then coming out and cutting rates, what did he do? He cut rates an hour before the market opened. Everybody already knew. So they said, screw it. And what did they do? They tanked the market after that. I mean, that's exactly how he did all of his talking. I mean, it was totally out of the norm. I mean, I remember him cutting rates one day at 11 o'clock in the morning. I mean, really? I mean, that's ridiculous.
They did have some surprise rate cuts. No, you're right, and that was his way of moving, right?
Yeah.
So
And the Fed guys now, I'm kind of on Jack's side. I mean, they're celebrities. I mean, every time you look over and you see a Fed guy coming up, you go, well, you almost kind of cringe at what the market's going to do next because you have no idea what they're going to say.
Yeah.
And so, and I think, you know, one thing that, I mean, what it does do, which is what I like, and I know Jack likes this, it pumps the premium in the options. And with that, I mean, if you're out selling no puts or selling calls or spreads or anything like that, you can pull in a lot of premium. Then, of course, when it starts to move a lot, you get that collapse out of them and cha-ching. I mean, that's the one great thing about it is that they do pump the premium in those options, which makes it great.
Yeah. Yeah, no, that's it. That's and you're, I mean, you see it even though it's not reflected in VIX so much in longer term. It's those premiums are getting pumped very near term, and we're going to talk about that dynamic in a little bit, right? I mean, there's been a massive shift in the way the markets use options and the kind of signals it sells. So yeah, we're going to talk about that in just a little bit. Yeah, you know, that's I think what the Fed is. Here's my 2 cents on you know, where the Fed, what's happening with the Fed and its impact on the markets, right? So we've got, you know, they're afraid to have to tighten more. So they're trying to talk their way through it to get the markets to do the work for it. Get the, you know, and you saw it reflected in bond yields this week. So, you know, as bond yields rise, that's doing the Fed's work without them having to put as much pain on the front end of the curve. But, you know, I believe inflation is a much bigger problem, much more persistent, sticky, and endemic than they're willing to admit. They just don't want to come to grips with it. Right now, the ECB, you know, the ECB is signaling they're going to hike a lot more. You know, I think that the Fed is trying to signal that they're going to hike a lot more, but I think it's going to be, you know, even though we've had this little lull in inflation, they're going to pay the price because it's could very easily rip back up, and then they're going to have to hike even more. So if they don't hike enough now, right, and if the market doesn't do enough of the work for them, they're going to have to hike even more in the future to cure something. You know, you can let a fire burn a little or a lot, right? And once it starts burning a lot, right, I mean, that's when you bring the bucket brigade, and that's an expensive proposition, right? And I think they're trying to ignore how big the fire can get, hoping it doesn't, but I don't think that's going to work out for them. So
well, that's one thing that I'm really surprised on. I know seasonality wise, I mean, you'll usually see, you know, gold and silver kind of cool off this time of year. But I'm really surprised that we haven't seen a bigger spike in gold, silver, copper, and just because of what is, you know, foreseen, I'll say, out into the future. I mean, they're going to have to, I mean, if they've got the, I guess I use a correct word, guts to do it. And if they have the guts to get, you know, the rates up to, you know, 6 to 8%, which they should, just to kind of, you know, level everything off, then you ought to see those metal markets take off and run. And I think you're going to see probably a 25 percent rise in gold and silver eventually by the end of the year. But I think right now everything's just everybody's kind of getting spooked a little bit in the market, and they're just kind of hanging things out right now.
Yeah. That's so last year I was really confused by the way gold traded towards the end of the year. At first it was very negatively correlated to the dollar strength that we were seeing, right? And right. That was kind of as expected, and things seemed predictable and reasonably normal, even though it was kind of a panic. It was a normal panic. And then it became, the beta on. So if you look at, or I'm sorry, the beta, the delta, basically the same thing. The relationship, the statistical relationship between gold and the dollar completely broke down, right? And the gold became very immune and kind of held its own, which you wonder if the Fed actually ends up getting behind the ball. Inflation rips a lot higher than it's supposed to. Maybe the Fed actually raises its long-term target rate for inflation, right? It says, okay, fine, we're fine with 2.5% or 3% or something like that, right? Gold could, there's a base potential building based on its resilience that it could really explode higher from that. But I've been scratching my head. I don't know, Jack, do you think much about gold and silver? I
hate gold.
Okay, fair enough.
I'm not into it. I can't even apologize for it. My dad, he was into the gold and silver thing, and I just think it's kind of like a generational thing. He went through the Depression and all that stuff, and these younger guys, like my boys, you talk about gold, they're looking at you like you're 3,000 years old. They into gold. And I just think that that's not the safe haven that it used to be. And people thought it was a safe haven. I've never seen anything. I just don't like gold.
Fair enough. Okay. All right. Well, we'll skip that one. I'm not going to put you on that. I'm not going to pull something out of you there. All right. Hey, let's move on. So speaking about kind of the lags that might be driving inflation and, the whole price landscape of goods, Geof, while we got you, I know you got a lot of thoughts on ag products. You and I, we talked a little bit before to figure out what would be a good topic. Why don't you start out? You were describing drought in the Midwest and hog and the impact on hogs and cattle. Why don't we do that? And then there's also a thesis you got on grains from South America and what's going on there. So why don't we talk through that right now for a little bit? I'd love to hear your thoughts.
Let me put some definitions out there just real quickly so people understand what I'm talking about real fast. When it comes to cattle, and some people might know this, some people probably don't. You hear bulls and steers, and you hear cows and heifers and stuff like this. A heifer is just a cow that hadn't had a calf yet. There, okay. A cow is had a calf. A steer is a castrated bull. I'll put it that way. All bulls are born as a bull, but they castrate them, they're a steer, and they keep some that are just bulls. So they never take bulls to slaughter or anything like that. They keep them out in the pasture to proliferate
grow the herd.
Yeah, grow the herd. So so when you look at a live cattle contract, you're actually controlling 40,000 pounds of steers. All right. So these are the ones that you're going to be feeding and then taking into slaughter, and then you get all the meat and all that good stuff. So when you're starting to look at the cattle markets, the one problem that we've had over really the past 2-3 years, we've had a lot of droughts out in the plains and some in the Midwest and stuff like that, which has really cut down the cattle herd quite a bit. There's some estimates that they've lost like 10,000 head. There's other estimates they've lost close to 25 to 30,000 head of cattle.
And what's that in terms of magnitude? Like, what's the over typical herd size?
And if you look back the big picture of the whole United States herd, it's not quote unquote that much, but you're looking at probably 20 to 30 million head, and so it's like I said, it's really not that much, but you're looking at a lot of farmers or ranchers that are going to lose their land because they can't afford anything. So they're going out of business. That's the biggest problem that you're starting to see there. Yeah. It's not a real quick turnaround. I mean, it takes a while to build a herd. You have, the gestation period of a cow is just like a human being. It's about 9 months. No big deal there, but it takes about 1.5 years before that calf can have a cow, if it's female, right? Yeah. So there's 1.5 years before you can start getting a calf out of that heifer. And so all of a sudden, you're looking at 3 years out to start building a herd. And if you go back, what was that in 2014? Somebody in Texas has going to have to correct me on this. 2014, 2015, there's a huge drought down in Texas. And they had no hay, they had no nothing. They just had to start either get rid of their cows, take them to the feed yards, or slaughter them, whatever, or just let them die. They don't want to let them die. They don't make any money that way. And it took them about 3-4 years to get that herd back up and running again. We're looking at the same instance here. You've seen live cattle really starting to take off because of this. If you just look at, can I share my screen? Is that okay, Don?
Of course, yeah, you sure can. Please do.
Okay. So I didn't want to break anybody's bubble here, but here we go. Now this is this is the live cattle futures contract, and you'll notice since literally last October, we were starting to get this huge rise, and the reason for this is naturally cattle have their calves this time of year. So we have over here, you got all your slaughter and everything like that. Everybody wants their pork and their beef and everything like that for the holidays. And you have a big, huge supply, and all of a sudden now we don't have any. And now the question is what's the herd going to be coming forward? And so they're pushing this thing up. And this is one thing you have to be very, very careful of when you're looking at like USDA reports, because for some reason they like to say our exports are $10 billion for this next year. And then they've increased that by 500 million because, well, it's not because we have more exports, it's because the price of cattle's gone up. So they're expecting to export the same amount, not more, but the price of cattle's gone up. And you can kind of see we've gone from $1.47 a pound to $1.65 a pound. So, and this is price per hundredweight here. So that's why it says 165. And that's the thing. And I don't see this coming back any. I think this is going to continue to push higher. I think we're probably going to see the 185 to 187 area in live cattle probably over the next 6-8 months. I mean, it's not going to go straight there. Don't get me wrong. You're going to have ups and downs based off the news, but you're going to see that continue to move higher. You see this also in the lean hog market. You've got a kind of a more abundance of pigs, but one thing that you don't have are chickens. We've had the avian bird flu kind of whip through everything, killed millions of chickens, some turkeys. I think they're still predicting turkeys to be okay, but we're going to have a decrease in chicken. And so you've seen chicken prices jump up. And this is why I watch commodities, just because I can figure out what the price of things are going to be at the grocery store. My wife comes in and says, I just paid $15 a pound for a frickin' roast. Yeah, live cattle went from $1.20 to $1.65. What do you think they're going to do to you? So, I mean, that's just it. And I think this is going to continue to push higher. I can't see where it's going to be kind of coming back any. Now, once we get into next year, we might be seeing more of, a bigger herd, depending on how this year goes. Do we continue the droughts, or do we get finally rain up in the plains this year? Right now, I guess they're getting a lot of snow from what I heard this morning. But we should be seeing a lot of that. And another thing that you kind of whip around on going into the grain market, because you have a lot of the grains that go to feed, right? Ukraine has thrown a huge wrench in the grain market. They're the 4th largest exporter of grains. And not only that, they are the world's largest exporter of sunflower seed. They grow more sunflowers in that country than anywhere else in the world. So if you see sunflower oil jumping up, that's the reason why. And even I kind of heard this yesterday, this morning, whatever it was, that the deal with grains being sold to Russia is ending this week. So they might not be able to be exporting a lot of their grains. I'm sure the Middle East would love to have it all, or even Africa. So, but we've got, this time of year going to the grains. Right now, we're in our winter time. We've got our winter wheats in right now, trying to figure out what they're doing. But down in South America, south of the equator, when we're planting, they're harvesting. So the big eye now is based off of Brazil and Argentina. They're going to be real big coming into the markets here in the spring to see what their crops are like. Is their corn crop good enough to sell for food? or is it going to have to go to feed because it's not as good a grade? And that's what they're going to be watching for right now, because Brazil ships everything to the Africa, the Middle East, China, stuff like that. We get some from them, don't get me wrong. We import some stuff, but we don't need a whole lot of grains and stuff. We have our own. So if you look at our imports, they're very, very low when it comes to the grain stocks, even crude oil and stuff like that. What our big imports are on the, what do they call that? The herbivorous, or whatever the word is, the other stuff, the bananas and the avocados and the coffee and the chocolate and stuff like that. We have to import all of that because we don't do anything with that. So we have huge imports in that. We have very low imports when it comes to our grains and everything like that, just because, well, we have trade agreements. Yeah, we'll take some of yours if you take some of ours, blah, 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 blah. But I think the big deal is what because they've had a lot of droughts in their northern region of Brazil. Right now, they're looking at the southern regions to see if they're having the same issues. And they're wanting to see what that soybean crop, that wheat crop, and that corn crop are doing down there. And I think that's where all the eyeballs are going to be looking at as far as, the grain markets. I think grain markets are going to be kind of volatile over the next 3 weeks or 3 months. I think you're going to see some ups and downs and backs and forths and right and lefts, just as we start looking at our crop progress coming forward. We're going to have probably a big crop progress. Well, I'll say a little bit of a major crop progress at the end of this month. At the end of next month is going to be huge, and so is April and May. They want to see what's in the ground, what's been planted, how healthy the winter wheats are. Have they been devastated by all the snow and the blizzards what we're having today, and so on and so forth. So I think the grain markets over the next 3 months are going to be very volatile. I think the meat markets are going to continue to push higher. Crude is one that I kind of scratched my head on a little bit. The dollar affects it some, but it's more of supply and demand. And I think what you're seeing in crude right now is you got, going back to the stupid Fed idiots, them telling us how bad the economy might be and how recession. I mean, you still hear people talking about a recession coming. Here comes a recession. We already had a recession. We're going to go double dipping here. I don't know. But they keep talking about that, and that keeps putting the cap on crude. It runs up, and all of a sudden, we're on recession fears, and it just dumps it right back off again. Yes. The one thing that I've been watching, though, and I don't know if anybody else watches it here, we got it daily here. You'll notice this is kind of spiked up here a little bit. We just changed the contract. This is gasoline. This is what you put in your cars. This is unleaded gasoline. Gasoline has been actually stronger than crude oil. Gasoline is right up around at 262, 263 a gallon right now. Crude oil is still down here at $75. Last time we were up here at this 262, 263, crude was up at 87, 88 bucks. So this tells me that people are still saying, hey, I don't think the recession's here. I'm still going to go out and buy gas. And crude oil is still kind of getting beat up a little bit here. Of course, you got a lot more traders in the crude market. You got a lot more hedge guys out there in the crude market than you do in this gasoline market. So I always kind of watch the gasoline market more than the crude market when it comes to energy, just because that's what I use. I don't use crude oil. I don't have a barrel of crude in my backyard. I got 6-gallon gas tanks in my backyard. So that's the thing I want to watch. And so I kind of watch the crude side of things just to make sure that the gasoline side of things, so I can make sure, you got to have crude to make the gasoline. And one thing, and I got to show you this, and most people don't do this. This is the geek in me. I got to show you this though. You'll like this. Maybe not. This is investing.com. And if you go, let's go to this week, scroll down. The EIA comes out on Thursday this week because we had a holiday on Monday. There's Wednesday, here's Thursday. If you look on here, right, do I have a little marker? I got a marker somewhere in here. I got to move stuff so I can see things. There we go. Annotate. There we go. Right in, where is it? Here we go. Right there. That's your crude oil inventories right there. Right now, they're expecting us to have a surplus of 1.6 million barrels of crude. All right. So, but if you click on that right here, I'm just going to take you through a little exercise so you can do this on your own. This is kind of a chart of the crude oil inventories. Yay, there it is. Down here is a table. You can click on more and more, and you can get all you want to out of here. But if you go over like the past 6 months, you can actually copy this and you can paste it into an Excel spreadsheet. And why I do that, and I'll show you why. Excel. This is for inquiring minds wanting to know things. Here we go. So if you take that and you just paste it in here, there it is. And what I do is I do a find and replace, and I take all the M's off. So M, replace all, and it takes the M's off. And then you can sum this up. And you'll find that over the past 6 months, we have a 49 million barrel surplus in crude oil. Now, everybody says, well, why is crude going down? Well, fundamentally, we've got more crude we can shake a stick at, if you want to look at it that way.
Yeah.
So we've got actually a surplus in crude. So there's another weight that's going into crude right now on the fundamental side is they've got a lot of crude oil. So they really don't need to be producing crude. And if you do that to gasoline, you got about a 16 million barrel surplus in gasoline. So, and that's
so you think, so really, I think the bottom line there is, there's you're starting to see possibly some slowing growth in the economy translate itself into inventories. And it's interesting, where didn't Biden just make another SPR release too?
He did.
Yeah, so that's curious.
Yeah.
When you don't really have that tightening, and he's taking those extraordinary measures.
Right.
I think the interesting, what's really, I think the great takeaway from what you shared with us, Geof, and this was excellent, was, you've got kind of within the U.S., you've got some pressures out there based on, drought and that sort of things that have lagged, but we could see much higher beef prices and pork prices and poultry prices come over the next coming months. And, the interesting thing out of Brazil there is, along with Ukraine, the kind of like the consumable grain prices, for what people would eat, there's some potential supply constraints there, really depending on what comes out of Brazil, because if they have to turn that stuff into feedstock, that's less that they can export. And then if Ukraine's got some tightness, you've got an overall those could become exports. We could fill that gap with exports out of the U.S. And then all of a sudden you've got the same price pressures that everybody else has around the world, right? So, so there's some examples of, just the other knock-on effects potentially driving prices higher outside of just, the money printing and regular monetary fueled inflation that we're most concerned about right now.
Yes.
There's other factors. Yeah, that's great. Cool, Geof. Well, I really appreciate that, man. That's awesome. Jack, we wanted to talk a little bit about volatility or the options that are how all this option trading volume has moved from 1 month, 2 month, 3 month out hedgers, and hedgers in this case are asset managers, right? When you're managing a large portfolio of mutual funds, or you're out there systematically hedging, just like oil producers are hedging their oil inventory, oil production. Asset managers, they hedge their risk, their book. Banks hedge their risk, their book, and the dynamic has changed a lot. Why don't you share some of the things that you've seen lately, because it's really fundamentally changing the way risks can be seen in the marketplace.
So much is changing, but you wouldn't know it on the surface. You got to dig like Geof is doing to really piece some of this stuff together. But I just want to share a couple interesting facts with you. Goldman Sachs has more cash on hand than at any other time in the history of the company.
Yeah.
Morgan Stanley has more cash on hand than any time in history. JP Morgan, same. The three largest Wall Street institutions have pulled 1.5 trillion out of the market. They got more cash than they've ever had in the history of their companies. And there's been a 100 times growth in institutions trading these short dated options, not just 0 days to expiration, but some with just out of a week out.
Yeah.
And that blows my mind. Just those 3 guys doing the exact same thing, the 3 biggest boys on the block, out of the market, and they're buying options, because same as hedge funds, they don't want to miss out any rally, right? They don't want to own the stock, but they don't want to miss out on something popping. So they're playing options as well. And the sum of all of this has generated a great quote from the CBOE. They said, you just got to get this, more than 40 million call option contracts changed hands in a single day in early February. That was the highest level on record. And get this, nearly topping 2022's daily average volume for puts and calls combined.
Yeah. So just the call options outstripped the total put and call total option contracts
for the whole year, one day.
Wow.
50, it's gone over 50 million now. And that propelled overall activity to 68 million contracts, which was also a record. So that stuff just blows my mind, that that much increase in options has kind of changed the dynamics between the underlying stock and the option. Like my whole 38 years in the market, I've always thought that the underlying stock totally controlled the option. Now, what I'm starting to see, especially on the short dated stuff, is that I think the options, the tail is wagging the dog now. I think that the options are leading the stock.
Yeah, especially, and that goes a long way to explaining these kind of crazy intraday volatility, without, the longer term moves, right? And so for everybody out there, just so they kind of get the kind of make a mental picture of what we're talking about, right? So VIX, the volatility implied index, right? So options trade on implied volatility. That's how they're priced. That's the main driver of price in an option. And it's saying, what do I think the volatility is going to be of this stock or this ETF or whatever over the coming months, right? So that's implied volatility. And the VIX index, I believe it looks at 1 to 2 months out. So it looks at option contracts, the VIX index, and then takes that, averages that implied volatility. I used to do this calculation every single day on the trading desk before there was a VIX. And then they average that sum, and that becomes your VIX index. Well, then now they have futures contracts based on that VIX index that guesses what that implied volatility is going to be 1 month out, 3 months out, 6 months out, right? So there's a term structure of implied volatility, and you can see, how volatility is expected to unfold over time. And we use the VIX because it's looking, a few weeks out. We use that to gauge kind of near-term anxiety in the market, right? But all that activity has moved to 1, 2, 3 days, so it doesn't even show up in the index, right? And so now you've got all this volatility that, nobody's getting any signals on it, but it's rolling over every single day.
Think about it like this: the VIX is broken.
Yeah, it is. No, that's right. That's right. I think your comment on how the tail wagging the dog, right? So in mortgage and bond markets, there's a similar thing that happens every now and then. And mortgage desks, you think of all the mortgage bond desks out there, every mortgage that's taken gets pooled and sits on a bank's desk, and they sit on those, and then they have to hedge those with their interest rate risk. They're sitting on this book of mortgage bonds. Their biggest exposure is interest rate risk, and they hedge it with treasury futures. Well, mortgage bonds and treasury futures don't act the same way when interest rates move. And so you could have a rally in mortgages sparking a massive sell-off in treasuries, and vice versa. It becomes a self-fulfilling cycle. And that comes down to convexity, which is exactly the same thing as gamma in options, right? Sorry to throw a couple big words out there, but those are exactly the same concepts. They move at different paces. And I think, maybe with all this these major intraday volatility moves. I think the people that are out there, a part of this is the actors that are systemically hedging, right? All the big players out there that have equity books and the banks and whoever's positioning out there, they have had to change the way that they hedge their risk. And by moving all the way up to the front of the curve, right, a lot of that volume can be explained by instead of hedging for 1-2 months out, they're hedging for the next day, or the next 3 days. The premium's really small. There's a lot more activity, but they're creating all this move that used to be reflected in the longer term is now in the short term, completely mixing up the signals, and it's really hard to predict what those risks are going to be.
Well, look at what they've done with the index options. They made them expire every day now.
Mm-hmm. Yeah,
I mean, talk about short
that's crazy.
term. I mean, that's like, here's tomorrow, here's today. I mean, that's exactly what they've done. I mean, and they keep expanding that. So
it's exploded too. The volume in those things has exploded, and the exchange saw a market for that. And the 0 DTE, 0 days to expiration, that's exploded.
Yeah. And so when you've got a lot of volume and let's say something that expires at 4 p.m. that day, and maybe the markets aren't moving in the right direction, everybody has to scramble, which only reinforces that move, right? They have to cover their positions or whatever, or they go put something else forward, which means somebody else is doing the same kind of thing. And you get these 40, 50-point moves, 100-point moves in the S&P every single day, just back and forth. And that's that tail wagging that dog, I mean, between the regular hedgers, I guess you could say, and then the retail and other speculators, hedge funds and stuff like that, playing and speculating all these very short terms because they have no idea. They have no idea about the long term. The long term is completely cloudy now, and now they have an instrument just to play very short term now, and that's I think that tail wagging the dog is could be one of those things that crops up that nobody sees, right? That is that black swan, right? A black swan, a turkey doesn't wakes up every single day and thinking everything's great until Thanksgiving comes around, and he doesn't know, and then all of a sudden something he didn't even know that this was Thanksgiving was a option, right? And then the unexpected surprises, the ones that nobody really knows how to quantify or dismisses as a risk. I think these very short-term options have the potential to prove a pretty volatile catalyst.
Yeah, and it's created a great opportunity for selling call options.
Yes,
seeing this increase in volume and this increase in premium, it's just made my pockets a little fatter. I don't know.
Well, why don't you talk about that, man? So what's I know you got something you can share with us. What do you see as a way to really take advantage of that?
Okay, I'm going to show you. I'm using a really cool strategy that I'll share with you.
Yeah,
a little bit here. So we're about to go here, right? We're done with the show, but before we do, I just sent out a trade that's targeting right around $500 by this Friday. What I like to do is get in on Tuesday for Friday's expiration. I like to create a credit spread, take at least $500 on Tuesday for that Friday's expiration. So there's no way for me to guarantee any future results with this, but it's based around a little known income method I've used with an incredible 97.1 success record. And while anyone is welcome to take me up on this new trade, I'm going to do something very special for the first 100 students that are in here today that are going to join me. Now, I do this every week. I take the trade myself. I've been doing it for over 10 years. And I got a lot of great students that have followed me that have done even better than I am. But I'm going to do something special for the first 100. And I'll give you a hint. It has everything to do here with this $500 right here. Now, I did a special reveal on this. And that's the $500 that I used for that. And if you want to be one of the first 100 to claim this $500 prize, plus access the brand new two-step trade I just posted, anybody can learn how to do this. Then all I ask is you take a few minutes right now and watch this brief presentation that I've just finished putting together last week. And to view it, the whole thing, it's at jackcartertrading.com/roundtable. And you can go there to unlock the initiative for free. It's a brilliant strategy with these calls being as high as they are, the premium now, this is a real good money maker. I'm in these trades for 3 days. I call it the 3-day cash machine. And I've just started this new initiative to get people back into a higher income bracket. And then that's what this is all about. It's all about income. So check that out. You're really gonna like it. It's the biggest project I've done in 10 years, and people are already just loving it. So check it out.
Well, who was it? Dave just said he's been with you 3 years, Jack, and he's 5x'd his money, turned 10,000 into $50,000. That's pretty awesome. This,
oh my God. Well, way to go, Dave. I love hearing that. That's Cyrus. That's my strategy for this market. Are you asking about how to do it? That's what we did. Dave, I can't believe that 3 years you took 10 grand and turned it into 50.
Incredible.
Oh, man, that's exactly what we're trying to do. So, everybody on here has the same talents and abilities as my most successful people. They just need some guidance and some direction, and to build their confidence. This is what you're going to love.
Well, and this plays right into as market shifts, and we're going through an unprecedented time in the market. Where a lot of the fundamentals that we all three of us grew up with, those books are getting thrown out of the window in a big way, right? Yeah. Not that this time is different, right? It's probably end up just being the same as it always been if you measure time a little bit longer, right? But it's been a fantastic. It's a fantastic environment to try new strategies, and everything we've talked about today talks about how it impacts that volatility, and it impacts those premiums that you see. Volatility drives those premiums higher, and even though you don't see it in the VIX, you see it. It's there, and strategy like this is a perfect way to take advantage of that.
Yeah, hey, look at what Nathan says. He says, nothing better than flipping what the dumb money crowd is doing and turning it into your advantage.
Right.
That's a great quote, Nathan. And here's the thing, folks, you got to know how to take advantage of your advantage. Okay, right. So this is what I'm trying to show you right now. We got an advantage here. You just got to learn how to take advantage of your advantage. All right.
Yeah, it's one thing knowing that there's an arbitrage exists, but you have to be able to take advantage of it, right? You have to know how to slap those trades together in order to do it. And that's what you're doing.
Dano, you don't need a lot of money to do this, Dano. This is not the kind of thing that prices people out because you need a large trading account. You don't.
Yeah.
You can make great income with a small account with this. I see it all the time. So Dave just happened to have 10 grand that he turned into 50, but a lot of people start with a lot less than that, I can tell you. Yeah.
Awesome. Well, let's get let me get a couple things there into the chat that I realized I haven't done yet. Let me get something going here. Sorry guys, this is me and being all thumbs here.
And just to kind of let you know, I track Jack's trades a lot myself. And in this, he's made 108 trades and won 105 of them. How's that?
Wow.
Yeah.
So
I didn't even know I was that good.
That's a 97.22% win ratio.
Okay.
So.
Hey, Laura, could you drop a couple things in the chat there on how to get let everybody be able to make sure they can take care of this? There's I know there's some links out there that we need.
Yes, sir. Sorry, here I am.
So we'll get you guys going on this in just a second here. We will see, but you got it right there. You can go to jackcartertrading.com and /roundtable and find out how to take advantage of it. It's fantastic. So there we go. Thank you, Laura. Awesome.
Going nationwide with this. Going to get everybody more money, targeting $2 grand a month for excess cash. That's the goal. So
so let's so walk me through it one more time. So what you're doing is 2 steps, right? So you get in on a Tuesday or Wednesday.
Get in on Tuesday morning. Monday is not a good time to do this. Plus, if you're only in the trade for 3 days, then you're shaving like 25 to 30% of your market risk out of it. I get in on Tuesday morning for Friday's expiration. So I use that 2-step trade to create a net credit. And I let those options expire worthless when they're out of the money. So you don't even have to close this trade out. Right. Most of the time, if they're out of the money, you do nothing. So you're just putting this trade on Tuesday. You get the cash, hits your account immediately on Tuesday. That's one thing that's crazy is that the money is guaranteed to hit your account when you sell options, that it's guaranteed by the CBOE. So that's awesome. You know, just it's just a perfect strategy. And Dickens, I encourage you, just go to the roundtable, watch your presentation. You'll really dig it.
You'll get it. Awesome. Well, Jack, you are definitely known for figuring out how to make money on the off premiums, and now it's salad days for you. I know you're loving this market. Even if you could care less about gold, that's okay. You don't care about gold. We'll forgive you for that, man. But you're just sitting there making money.
I got to stay in my lane, Don. I can't be good at everything. I can't be an expert on everything. I'm just a regular guy from Indiana. I never had enough money to get into gold, so you know.
That's right.
I mean, and I grew up in the steel mill town, but yeah, not into
Awesome.
gold. I just stay in my lane, and I like what I'm doing.
All right, that's excellent. Excellent. All right, guys. Well, hey, it's been a great show today. Really appreciate it, Jeff. All that detail on the global ag markets. Really appreciate that, and I appreciate everybody's input on this. Guys, go in there and just check out this video. Check out Jack's. Check out what Jack has put together, this two-step trade system. Seriously, everything we're talking about today has just built massive premiums that you can take advantage of by credit spreads. It's tailor-made for this time. So check out the link, go in there and join his product, because this is fantastic. Join his service, because this is a fantastic way to get through all this volatility and make it work for you. Fantastic. Definitely. Yeah.
Jeff, I loved hearing you talk about beef, man. And next time you're on, I want to come on. I just can't get enough of that beef talk.
Wonderful. Wonderful. I'll be on Ask the Pros, I think, next week, actually.
Awesome. Yeah,
all right. Well, we'll be there. Excellent. Okay, guys. Thank you very much. That's it for today. And we'll catch you. Everybody, appreciate you joining us today. We'll catch you next week, next Wednesday, 10 a.m. Eastern. We're going to have another great lineup for you. We will talk to you then. All right, everybody.
Thanks, Don. Appreciate it.
Yeah, appreciate it, Jeff. Thank you very much. See you, Jack. Thank you.
Good seeing you, Jack.
Good seeing you, Jeff. See you, Don. Thank you.